Hey everyone, welcome back to Corporate Decoder. Today we're diving into Tompkins Financial Corporation's quarterly report. Think of it as their financial diary for the last 3 months. Are they thriving or just surviving? Let's decode what's really going on, because sometimes financial reports are like onions, lots of layers, and you might cry a little. First, the headline, Tompkins Financial seems to be doing pretty well. Their profits are up compared to last year, which is always a good sign. That's about $19.7 million, a jump from about $16.9 million the same time last year. And so where did that extra money come from? It all boils down to making more money on loans. Think of interest income as the rent Tompkins charges for lending money out. They pulled in about $78.6 million, that up from $71.6 million the previous year. This means they're lending more and at a higher rate or both. Now, where does the money come from to pay it out? They spent about $32.8 million in interest, not much different from the $32.55 million the year prior. Basically, it shows they have managed to balance making income without a proportional increase in costs. A win, and however, the report highlights one detail: their provision for credit losses has gone up. This is basically an estimate of how much money they might lose if people can't pay back their loans. The expense has jumped to $5 and $3 million compared to only $855,000 last year. It could mean they see a bump in overall risk with future customers not repaying their loans. But for now, this hasn't impacted their profits overall, and net interest income, the amount earned on loans over their cost of funds, is doing well. The increase in this income came from a shift in how they're investing their money, focusing on higher earning assets and paying closer attention to deposit rates. Let's now look into the actual non-banking operations. The insurance business seems to be doing pretty well. Commissions are up to $11.6 million from the prior year. Their wealth management division also saw some nice gains and earning $5.9 million the year prior. It's not all sunshine and rainbows. There were also offsetting expenses. Their employee cost and what they pay people has gone up to about $25 million last year. That's expected as the company expands its headcount to manage the expanding business that can. Where does Tompkins see their risk? Legal battles are a normal part of business, and Tompkins acknowledges this, but they don't see anything currently that would be a major problem. Tompkins also mentions a few other risks, although nothing particularly stands out to me. They need to stay ahead of hackers and data breaches, which is a huge concern for any company dealing with sensitive financial data. While net income saw a boost, it's worth noting unrealized losses are present, a technical term to describe the fluctuations in investment values not yet realized through actual sales. The fluctuation stems from the bond market causing a change in the amount for available for-sale debt securities, but overall the company has taken steps to protect against it. Now let's look into the equity and how it might translate to the future. At March 31, 2025, their balances total around $299 million. One of the bigger outflows is their dividend program, with nearly $9 million flowing out in that area. All of this leads to Tompkins being well capitalized, and their books look pretty solid with healthy capital ratios. As a financial holding company, Tompkins is tied to the rules of agencies like the Federal Reserve, the FDIC, and even the New York State Department of Financial Services. Tompkins has about $1.3 billion spread out over debt instruments. Their biggest holdings come from mortgage-backed securities from US agencies, with more conservative instruments such as US Treasuries and smaller investments in state and local governments. They do, however, have some gross unrealized losses. Those are losses they could have if they sold everything today. Most of those losses would stem from US government securities. So what's the verdict? Is Tompkins Financial a buy? XM, their focus on responsible growth in their geographical locations is good. It will be important to keep looking into that provision for credit losses metric in future quarters, which might signal an industry-wide risk as well, not just something unique to Tompkins. They also highlight that one of their risks might involve a concentration of their business. It means they need to make sure to be more diversified across the customer base. Their business relies on outside sources like the Federal Reserve, FHLB, as well as third-party services, LPL. It'll be important to see they have good relationships that might help their business. Overall, a diversified banking business will benefit them. Alright, that's our breakdown of Tompkins Financial's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. And before I forget, don't forget to check out the Discord in the description. A great place to discuss the filings, ask questions, and suggest companies to analyze. See you there.